OpenAI is facing a deepening financial problem. The numbers, examined closely, point in a consistent direction. In 2025, OpenAI reported approximately $24 billion in revenue. At the same time, the company was losing between $8 and $14 billion annually, with those losses continuing to grow. In March 2026, OpenAI closed a $122 billion funding round, the largest private investment in history. Even so, the financial math remains strained. The core issue is structural. Unlike conventional software, where operating costs remain relatively stable as a product scales, AI development follows what are known as scaling laws. To meaningfully improve model performance, compute investment must increase by a factor of 5 to 10, not 2. Training GPT-5, released in late 2025, required over $1 billion in compute costs alone. Projected training runs for the next generation, expected in 2027, are estimated at $5 to $10 billion each. These are not one-time expenditures. Continuous retraining is required simply to remain competitive in a market where comparable technology is increasingly available at low or no cost. The result is a structural bind. Costs are tied to physical inputs, electricity, hardware, and silicon, all of which are expensive and supply constrained. Meanwhile, pricing power is limited by the volume of competition the market now carries. Microsoft has invested tens of billions of dollars into OpenAI. In April 2026, the two companies renegotiated the terms of their partnership. For years, OpenAI operated exclusively on Microsoft's Azure cloud infrastructure. Under the revised agreement, OpenAI became a multi-cloud company, signing a $38 billion contract with Amazon Web Services and entering a partnership with Oracle. The shift is significant. OpenAI's compute demands had grown to a scale that Microsoft, one of the largest technology companies in the world, could no longer meet alone. The exclusivity that defined the original partnership was effectively dissolved. There is a related financial constraint. Compute credits cannot cover operational expenses such as researcher compensation, which at OpenAI can reach $2 million per year per individual. The company relies on direct cash investment from outside parties to cover payroll. When ChatGPT launched, it operated without direct competition in the consumer AI space. By early 2026, its market share had fallen below 60%. Google's Gemini is now integrated across Android devices and Google Workspace. Grok, developed by Elon Musk's xAI, has reached approximately 20% of the US market. Anthropic's Claude has gained significant ground among developers and enterprise users. Unlike competitors such as Google or Microsoft, OpenAI has no existing business generating revenue to offset AI-related losses. There is no secondary operation providing financial stability while the core product scales. Compounding this is a technical development the company calls the scaling plateau. For several years, increasing compute and data inputs reliably produced measurable improvements in model capability. GPT 5.1, released recently, indicated that those gains are beginning to level off. If additional investment no longer produces proportional improvements, the assumptions underlying OpenAI's $852 billion valuation become difficult to sustain. OpenAI recently finalized a contract with the U.S. Department of Defense for autonomous defense systems. For an organization founded explicitly as a nonprofit oriented around public benefit, the agreement represents a substantial departure from its stated founding mission. The contract reflects the company's need to pursue revenue from available sources to sustain operations. At the current rate of expenditure, the capital raised in the 2026 funding round is projected to be largely depleted by mid-2027. At that point, OpenAI would face a limited set of options. It could pursue an additional funding round, potentially at a lower valuation than the current one, an outcome that would likely trigger significant staff departures among employees whose compensation is tied to equity. Alternatively, it could pursue an acquisition. The most plausible acquirer is Microsoft. The company already holds nearly 30% of OpenAI and has the capital reserves to absorb the ongoing losses. For Microsoft, a full acquisition would consolidate ownership of a technology it has already built its AI infrastructure around. This is unlikely to unfold as a sudden collapse. The more probable outcome is a structured transition, announced through a press release framing it as an expansion of an existing relationship. OpenAI demonstrated that large-scale AI systems could be built and deployed commercially. It also demonstrated that sustaining them requires capital and infrastructure at a scale that only a small number of organizations globally can provide. The independent startup phase of the AI industry appears to be ending. The company most responsible for initiating it may not remain a standalone entity long enough to see where the technology leads next.